Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Daniel Lam, your host for the podcast. I was the MC at the annual dinner of the Hong Kong Chess Federation on Saturday. While I was very busy on stage, I was answering many questions from the attendees about the markets off stage. I think there are a couple of reasons for this. Many laymen were impacted in their portfolio this year, and the root cause of the fall this time, as opposed to most bear markets in the recent past, was due to inflation, which is front and center to our livelihood. This week, we are going to get a set of speeches from the Fed speakers. But we believe the tone is likely to be the same as the FOMC meeting last week, i.e. the Fed is likely to be hiking rates until inflation is really brought back down in control. The increase in the FOMC dot plot to 4.375 and 4.625 for this year and 2023 respectively shows that in order to bring inflation under control, the Fed will likely to deliver a magnitude of monetary tightening that will likely inflict a fair amount of pain on both consumers and businesses. The implication is that the Fed accepts that monetary policy will cause a significant slowdown in the economy, and it is unlikely to reverse the monetary tightening with rate cuts to prop up the economy. So chances of a Fed pivot next year is now almost non-existent after last week's meeting. So let's check the technicals here. In some indices, such as Hang Seng Index, it is already at the year low. For S&P 500, intraday on Friday, it was also testing the year low at 3637, but managed to hold for the time being. There's increasing likelihood that the S&P 500 may enter the 3250 to 3540 support zone next month. So we prefer a three-pronged approach, so to speak, the 3D's, to mitigate the impact for investors. First D is de-risking of allocations by reducing exposure to equities and government bonds, which are amongst the most vulnerable to rising rates. Diversifying is the second D. You would like to diversify into less volatile and high-quality dollar-denominated investment-grade corporate bonds in Asia and the developed markets, which now carry the added attraction of paying the highest yield in the decade. And thirdly, increasing exposure to other income assets, including a basket of consistently high dividend-paying equities, that's the third D, which tend to outperform in high inflation regimes. That's all from me today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.